Why is none of the other elements ever mentioned? Is it a real concept or just some fragments of something else? When it deals with accounting statics, it does it well. But as soon as the modern accounting faces accounting dynamics, it shows clumsiness and helplessness. Income and expenses characterize changes in claims, more specifically in equity. Cash flows characterize changes in resources, more specifically in money. That financial performance idea seems to overshadow everything. Income and expenses does not inform us of changes in assets and liabilities. They tell us only about changes in the difference between them. But aren't these changes in assets and liabilities elements of financial statements? Certainly they are, but such unruly elements like unwanted children. This is the whole list of elements of financial statements. We have 4 static elements and 16 dynamic elements. It is the system. Each element has its proper place. Each element relates to other elements, and we see exactly how it relates to them. Why do we need accounting? To comprehend a business, to see a picture of it. To make this picture comprehensible, a special tongue is used, the accounting tongue. It consists, like any other language, of certain elements. In the IFRS Conceptual Framework for financial reporting, they are called elements of financial statements. Let's try to understand this phenomenon, element of financial statements. How many types of such elements exist, and how are they related to each other? Unfortunately, the conceptual framework does not address these questions. All it aims at is the definitions of some elements, but far from all of them. The conceptual framework does not even attempt to browse a list of elements of financial statements, not to mention bringing them into a kind of system, identifying the relationship between them. There is a rather strange statement in paragraph 4.1 of the CF. The elements of financial statements defined in the conceptual framework are, and then it addresses only 5 elements: assets, liabilities, equity, income, and expenses. Based on the wording, one could guess that there are other elements of financial statements that are not defined in the CF. And that's really true. But why are they not defined here? Even if we put aside these definitions, why is none of the other elements ever mentioned? Is it a real concept or just some fragments of something else? Apparently, the CF is hesitant to go beyond the 5 classic elements because further lies the uncharted area. But international accounting standards have long been tackling elements of that area. So it is not an uncharted one, but rather obscure. Well, then let's get the curtain off this area. In other videos, we have repeatedly concluded with you that any quantifiable accounting information is either static or dynamic. I mean, if accounting information is measurable, it is measured either at a point in time or over a period of time. In this regard, the extensible business reporting language, XBRL, uses terms instant and duration to refer to any quantifiable indicator of financial reporting. Hence, this is where we should start considering the elements of financial reporting. In this regard, I want to draw attention to an interesting feature of modern accounting. When it deals with accounting statics, it does it well. But as soon as the modern accounting faces accounting dynamics, it shows clumsiness and helplessness. So does the conceptual framework. It has more or less succeeded in handling static elements of financial reporting, but completely failed dealing with dynamic elements. Let's look at the already mentioned paragraph 4.1. There are two subparagraphs, A and B. Assets, liabilities, and equity which relate to a reporting entity's financial position. These are obviously static elements. Their value is measured at a certain point in time. And here is the complete list of such elements. Of course, we can divide assets, liabilities, or equity into more detailed sorts of elements. For example, I would allocate money from the resources and consider them separately from other assets, but more on that later. Now, I'd like to draw your attention to the fact that in any case we cannot add any additional element from the outside. The list of static elements is perfect because they are internally balanced. Well, subparagraph B is more interesting. Income and expenses which relate to a reporting entity's financial performance. That's all, nothing more. But wait a minute, what the fragment is this? Piece or slice or some sort of? Obviously it's part of something bigger. All that we can find out from here about these select elements is that they relate to a reporting entity's financial performance. Hardly anyone will dispute that income and expenses relate to the entity's financial performance. They definitely do, but only income and expenses. Not at all. The first chapter of the CF states that financial performance is reflected in the financial statements by two types of indicators. There is financial performance reflected by accrual accounting and financial performance reflected by past cash flows. Paragraphs 117, 119 of the CF speak of the financial performance reflected by accrual accounting. Paragraph 1.20 of the CF speaks of the financial performance reflected by past cash flows. Here we are. We have found in the very conceptual framework other elements of financial statements which also relate to the reporting entity's financial performance, the past cash flows. The authors of the CF, having reached the fourth chapter, managed somehow to forget about them. It is noteworthy that paragraph 1.20 refers not only to operating cash flows, but also to investing and financing cash flows. In this regard, the following paragraph, 1.21, which refers to changes in economic resources and claims not resulting from financial performance, seems ridiculous. The only example of such changes this paragraph provides is issuing debt or equity instruments. But isn't this the financing cash flows just mentioned in the paragraph above? Do you see any difference between borrowing of debt and issuing debt instrument? Because of my narrow-mindedness, I don't, but the authors of the CF, by virtue of their enlightenment, do. They see such a big difference that borrowing of debt in paragraph 1.20 is cited as an example of financial performance, and then paragraph 1.21 below states that issuing debt instrument is not resulting from financial performance. Okay, well, I don't want to banter over the flaws in the text of the CF because I suspect what the origins of this are. After all, the financial performance is a rather vague concept, whose essence depends on a lot of conventions, especially if we try to consider it simultaneously from the position of both accrual accounting and cash flows. For example, an IPO is one of the most important performances that an entity's management performs. The attention of users of the financial statements is focused on the results of the IPO much more than on profits for the period. But according to the CF, the result of the IPO should not be included in the statement of financial performance, as it is the result of raising funds from shareholders. Clearly, we need a more formalized basis for identifying the elements of financial statements. And the formalization here is quite simple. On the one hand, we have changes in reporting entities' equity, and on the other hand, we have changes in reporting entities' money. Both are important to users of financial statements. Changes in equity and changes in money. Don't these two look more clear and comprehensible than those speculations about different types of financial performance described in this year by clumsy wording such as accrual accounting versus cash flows? Actually, I think the term accrual accounting is out of date. Its use in the conceptual framework of the 21st century seems unnatural, because today no one considers accruals of income and expenses as an alternative to cash flows. They are just different kinds of information, but certainly not alternatives to each other. Both are presented in the respective financial statements. They characterize changes in different kinds of financial position elements that are on different sides of balance sheet. Income and expenses characterize changes in claims, more specifically in equity. Cash flows characterize changes in resources, more specifically in money. When we talk about changes in equity, inflows are reflected on the credit side of accounts, and outflows are reflected on the debit side. With changes in money, we do the opposite. Reflect inflows on the debit side and outflows on the credit side. Now you see the reason for separating money from other assets, as I said before. Just as in the right side of the balance sheet we divide claims into equity and liabilities, so in the left side we have to divide resources into money and assets. We have to do this at least because the changes in money are specific elements of financial statements. In this sense, they are like changes in equity, like income and expenses. And it would be more appropriate to use the word assets to refer not to all resources, but only to those that are not money. I mean not cash and cash equivalents, speaking in terms of IFRS 7. In this case, chapters 5 and 6 of the CF of recognition and measurement will be better understood, since all the provisions of these chapters on assets are hardly applicable to money. And this is true not only for the CF, but also for all IFRS that deal with the recognition or measurement of assets. Okay. Let's look at changes in equity and changes in money in terms of identifying elements of financial statements. First, what are the changes in equity? They are obviously not just income and expenses. The elements of changes in equity can be easily identified by a set of three related statements in financial reporting: the statement of profit or loss, the statement of comprehensive income, and the statement of changes in equity. These elements are profit or loss, OCI, other comprehensive income, and transactions with shareholders. You see, I didn't mention the income and expenses at all. This is because the income and expenses are just elements of a lower level. They are merely a profit-loss specification. Any dynamic element of financial statements can be specified in this way. After all, we are talking about flows, and among them there are always inflows and outflows. For example, there are contributions from shareholders and distributions to them. In OCI we also can distinguish positive revaluations and devaluations. By the way, speaking of OCI, I really do not like the name of this element because of the word other. We usually quote something with such a word when we don't know what we are talking about. Is there really such a case? Don't we know what OCI is? I would suggest something like unrealized revelations or potential reassessments or some sort of. The terms are of course disputable, but anyway, they are at least better than such a super meaningful name as other comprehensive income. So let's agree that I will call the OCI unrealized revelation, okay? Just in this video. And let's agree that we will not go down to the level of inflows and outflows, but will remain at the level of aggregated elements. Then we have three elements of changes in equity: profit loss, unrealized revaluation, and transaction with shareholders. Which of these three do relate to financial performance and which do not? I don't know, and frankly I have no particular desire to find out. What important is that these three elements characterize changes in equity. That's enough. This characteristic is much more accurately determines their place in the system of elements of financial reporting rather than in distinct affiliation to the financial performance. To be completely accurate, it is necessary to add one more kind of changes to these three. I mean structural changes, when the total equity value does not change, but its constituent elements change at the expense of each other. An example of structural changes is the conversion of accumulated revaluation surplus of an item of PPE into retained earnings at the moment of its recognition or as depreciation is accrued. In total, we got four elements of changes in equity: profit loss, unrealized revaluation, transactions with shareholders, and structural changes. That's it. Now we move to the other side of the balance sheet to changes in money. We are dealing here with cash flows. Their elements are also easily identifiable because they correspond to the relevant statement and are set out in the requirements of IAS 7 statement of cash flows. The standard classifies cash flows into flows arising from operating, investing, and financing activities. That the elements of changes in money are operating cash flows, investing cash flows, and financing cash flows. Aside from the cash flows, there are structural changes occurring in money that do not alter the total amount of cash and cash equivalents. An example of structural changes is the receipt of cash by the cashier from the current bank account. Well, we more or less sorted out the changes in money and equity. Now, what about changes in other resources and claims? Users of financial reporting need information about all of them, not just some of them, don't they? According to paragraph 1.4 of the CF, to make the assessments described in paragraph 1.3, existing and potential investors, lenders, and other creditors need information about the economic resources of the entity, claims against the entity, and changes in those resources and claims. And then paragraph 1.12 states that general purpose financial reports provide information about the financial position of a reporting entity, which is information about the entity's economic resources and the claims against the reporting entity. Financial reports also provide information about the effects of transactions and other events that change a reporting entity's economic resources and claims. Both types of information provide useful input for decisions relating to providing resources to an entity. Well said indeed. But further, unfortunately, the conceptual framework completely failed to explain what changes in resources and claims are. Paragraph 1.15 says that changes in a reporting entity's economic resources and claims result from that entity's financial performance and from other events or transactions such as issuing debt or equity instruments. That's all. No hint of any other kinds of changes in resources and claims. Users need to be able to identify those two types of changes. But according to paragraph 1.20, as we have already found out, the transactions such as issuing debt or equity instruments are not other events. They are still in the perimeter of financial performance, the one reflected by past cash flows. If you want to call them as two types of changes, then you have just to call a spade. Just proclaim that there are changes in equity and changes in money. But we've already figured out everything we need to know about these two types of changes. Here we are again marking time. That financial performance idea seems to overshadow everything. Apparently, this idea is to blame for the fact that all the changes in resources and claims degenerated in Chapter 4 only into income and expenses. To be honest, there are two items of other changes in economic resources and claims in the table 4.1 in paragraph 4.2 of the CF. Both of these elements have the same name, a very informative name, dash. The first one is contributions from holders of equity claims and distributions to them. Apparently, here again we are talking about either changes in equity or changes in money. The dash does not make it possible to understand which side is in question. If we talk about changes in resources, such changes are reflected in the statement of cash flows as flows from financing activities. If we talk about changes in claims, such changes are reflected in the statement of changes in equity as dividends or other distributions to shareholders or contributions from them. Here we go again. We walk in a vicious circle, swinging between these changes in money and changes in equity. How do we manage to move on to changes in assets and liabilities? But wait a minute. The second item here is promising. It says something about assets and liabilities. Here are exchanges of assets or liabilities that do not result in increases or decreases in equity. That's great. I think this phrase is the apogee of CF's inability to address the dynamic elements of financial statements. Why on earth only changes that do not result in increases or decreases in equity? What about changes that do result in increases or decreases in equity? I mean changes in assets or liabilities, not changes in the equity itself. Have they forgotten about them the same way they forgot about cash flows before? Why are they so obsessed with the equity? A change in an asset or liability may result in a change in equity, or money, or both, or neither. Information about changes in assets or liabilities is not the same as information about the results of those changes. The reflection of any fact in the accounting and reporting always has two sides, debit and credit. Knowing information about one side, I still have no idea about the other side. Income and expenses does not inform us of changes in assets and liabilities. They tell us only about changes in the difference between them. That is, changes in equity. None of the so-called primary financial statements contains information on changes in assets and liabilities. Maybe there are no such data in the financial reporting at all? Actually, there are. And in IFRS, there are relevant requirements for presenting such data in the financial statements, in those statements that have not yet been awarded the title primary. Here are some examples from the standards. IS 38, Intangible Assets, paragraph 118. An entity shall disclose the following for each class of intangible assets: a reconciliation of the carrying amount at the beginning and the end of the period showing additions indicating separately those from internal development, those acquired separately, and those acquired through business combinations. Assets classified as held for sale or included in a disposal group classified as held for sale in accordance with IFRS 5 and other disposals. Increases or decreases during the period resulting from revaluations under paragraphs blah 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 and from impairment losses recognized or reversed in other comprehensive income. Impairment losses recognized in profit or loss during the period. Impairment losses reversed in profit or loss during the period. Any amortization recognized during the period. Net exchange differences arising on the translation of the financial statements into the presentation currency and on the translation of a foreign operation into the presentation currency of the entity, and other changes in the carrying amount during the period. These are really changes in assets, not an ersatz, not the flip side in the form of income and expenses, but the changes themselves. Here's another similar example. IAS 16, Property, Plant and Equipment, paragraph 73. The financial statements shall disclose for each class of property, plant and equipment a reconciliation of the carrying amount at the beginning and end of the period showing additions, assets classified as held for sale or included in a disposal group, acquisitions through business combinations, increases or decreases resulting from revaluations and from impairment losses recognized or reversed in other comprehensive income. Impairment losses recognized in profit or loss. Impairment losses reversed in profit or loss. Depreciation. The net exchange differences arising on the translation from the functional currency into a different presentation currency. And other changes. Want an example from the other side of the balance sheet? An example of changes in liabilities? Here it is. IAS 37 Provisions, Contingent Liabilities and Contingent Assets. Paragraph 84. For each class of provision, an entity shall disclose additional provisions made in the period, including increases to existing provisions, amounts used, incurred and charged against the provision during the period, unused amounts reversed during the period, and the increase during the period in the discounted amount arising from the passage of time and the effect of any change in the discount rate. You can be sure that there are similar requirements for almost all items of the statement of financial position. An entity shall disclose changes in these items for the reporting period in its financial statements. Such statements are referred to as the inconspicuous word notes, but they are still statements, although not the primary ones. They are integral part of financial reporting. But aren't these changes in assets and liabilities elements of financial statements? Certainly they are, but such unruly elements, like unwanted children, the conceptual framework does not want to acknowledge them at all. The standards have grudgingly admitted them to their text, but do not allow them to be among the primary statements. Provisions on changes in assets and liabilities are scattered by different standards. There is no single system for them. The wording of the standards is different and sometimes contradictory. In some cases, the provisions are quite puzzling. For example, according to paragraph 37 of IAS 2 inventories, information about the carrying amounts held in different classifications of inventories and the extent of the changes in these assets is useful to financial statements users. No doubt it's true, but the reasoning about the needs of the user is very poorly correlated with the requirements for the presentation of information set out in previous paragraph 36. Only subparagraph B requires the presentation of the carrying amounts of inventories in classifications. There is no word about how to reveal and explain the changes in these amounts for the period. Only 3 subparagraphs D, E, F indirectly relate to those changes. But look what a strange sample. All 3 subparagraphs are talking only about the recognition of inventory as an expense and only the total amount with no classifications. What an obsession with expenses! It appears that paragraph 37 does not correctly describe the user's needs. Judging by what is required by the previous paragraph 36, the user of financial reporting is a notorious pessimist. He is only interested in the negative. Therefore, no inflows interest him at all. And of all the outflows, he is interested only in those that reduce profit or produce loss. In short, all he wants to know about changes in inventories is how much was recognized as an expense. Actually, he had already seen the detailed expense information in the P&L statement and in the notes to it. But this pessimist is so fond of looking at expenses he wants to see them again in the notes to the statement of financial position in the form of disclosures on the line inventories. Okay, let's stop mocking the shortcomings of IFRS and try to bring all these changes in assets and liabilities into a coherent system. Let's take 2 fundamental accounting policy issues as a basis: recognition and measurement. By the way, this is what the chapters of the CF are called. I mean those following after the chapter about the elements of financial reporting. Chapter 5, recognition and derecognition, and Chapter 6, measurement. In order to appear in accounting records, an item of asset or liability must be recognized. The CF establishes general criteria for recognition of assets and liabilities. IFRS specifies these criteria for particular assets or liabilities. As soon as these criteria are no longer met, the item gets derecognized. Examples of asset recognition are purchasing, self-constructing, expenditure incurred, acquiring through business combinations, contributions from shareholders, granting loans, providing goods, works and services, and others. Examples of asset derecognition are selling, losing ability to generate economic benefits, financial leasing, repaying debts, and others. Examples of liability recognition are getting loans, receiving goods, works and services, taken as a result of business combination, forming tax base, constructing a facility which implies future decommission costs, and others. Examples of liability derecognition are repaying debts, fulfilling through provision of goods and services, transferring to another entity with selling the related asset, cancelling due to expiration, and others. We have thus identified one of the financial reporting elements that characterizes changes in assets and liabilities. It is recognition-derecognition. Then we move on to the measurement. Another type of changes in assets and liabilities relates to changes in their carrying amounts after recognition. Such changes can be referred to as revaluations. Most often the revaluation is performed by adjusting the carrying amount of the item to its fair value. Other examples of revaluation are impairment, doubtful debts allowance, recognition of accrual gains and losses, etc. In some cases, revaluation substitutes the recognition, like in the case of biological assets or derivatives. In such cases, the recognition is performed by changing a zero value to non-zero. So we have identified the second element of changes in assets and liabilities. It is revaluation. But there is a type of changes in assets and liabilities that, on the one hand, relates simultaneously to both recognition and revaluation, and on the other hand does not relate to either. These are the preset changes in the carrying amount of asset or liability due to the passage of time, which take the form of progressive accruals made on a systematically recurring basis. Examples of such accruals are non-current asset depreciation, amortization of discounts of provisions, accruing interest on debt financial instruments, etc. For example, the depreciation of a fixed asset reflects the asset's gradual loss of ability to generate economic benefits. From this standpoint, it characterizes the derecognition of the asset. It looks like its gradual disposal. On the other hand, depreciation reflects the decrease in value of the asset, the same way as its impairment. So, in this context, it characterizes its devaluation. The same about debt instruments. On the one hand, the accrual of interest or amortization of discount means the emergence of another debt. This part is often paid prior to the main amount, and from this point of view it characterizes recognition of the item. On the other hand, such accruals change the value of an existing asset or liability, and from this point of view they characterize its evaluation. I'm not inclined to provide a theoretical justification for assigning such accruals to either recognition or evaluation. Anyway, they have signs of both. The specific nature of such changes in assets and liabilities deserves to be placed in a separate class of dynamic elements. Let's call this element of financial statements amortizations. So, the third element of changes in assets and liabilities is amortization. Thus, we have three elements which characterize changes in assets and liabilities: recognition, revaluation, and amortization. But since we have paid attention to structural changes in equity and money, we should not forget about them here. Structural changes occur in assets and liabilities when they are reclassified from one class to another, while the total amount of assets or liabilities remains unchanged. Examples of structural changes in assets are reclassifying investment property as property, plant and equipment, reclassifying PPE as non-current assets held for sale, and others. Examples of structural changes in liabilities are reclassifying long-term debts as short-term, reclassifying employee benefits provisions as accounts payable to employees, and others. Hence, the total number of types of changes in assets and liabilities is also 4: recognition, revaluation, amortization, and reclassification. Let's take the provisions of some standard as an example and try to sort the required indicators by these types of elements. Let us take the same IAS 16, Property, Plant and Equipment, paragraph 73E, which we have already quoted. The first item, additions, apparently means the capitalized expenditures on creation of new property, plant or equipment and upgrading of the existing PPE. This is definitely recognition. The second item is assets classified as held for sale or included in a disposal group classified as held for sale in accordance with IFRS 5. Obviously, this is a reclassification, but here the phrase "and other disposals" is misplaced. The provision of the standard confuses two different types of changes. A classification of non-current assets or disposal groups as held for sale or as held for distribution to owners is no disposal. The asset does not go anywhere. It only changes the name and order of further accounting. It is reclassification. And if you talk about other disposals, they should be certainly derecognition. Thus, the second subparagraph mixes the different elements of changes in assets. Next item is acquisitions through business combinations. This is also recognition. Item number 4 is increases or decreases resulting from revaluations and from impairment losses derecognized or reversed into other comprehensive income. This is all about revaluation. Next two subparagraphs 5 and 6 both talk again about impairment losses, first recognized in profit or loss and then reversed in profit or loss. Sounds funny, losses recognized in loss, and even better, losses reversed in loss. But never mind, it is about revaluation again. And an interesting thing is here. You see, in terms of changes in equity, an impairment loss recognized or reversed in other comprehensive income is not the same as an impairment loss recognized or reversed in profit or loss, because profit and OCI are different elements of changes in equity. They characterize different aspects of those changes. But they are not elements of changes in property, plant and equipment. Profit or loss or OCI do not characterize changes in asset itself. In terms of changes in an asset, impairment is impairment, wherever its effect is recognized in profit or in OCI. Here again we are dealing with two different sides of the same event, debit and credit. Users of financial statements want to see information about both sides. Information about one side differs from information about the other. They are therefore expressed through different elements of financial statements. And we continue to talk about the elements of changes in assets, more specifically in property, plant and equipment. Next, paragraph 7. Depreciation. We have agreed to call this type of change the general term amortization. And finally, 8. The net exchange differences arising on the translation of the financial statements from the functional currency into a different presentation currency, including the translation of a foreign operation into the presentation currency of the reporting entity. Since these are changes in the value of an asset, this type of change relates to revaluations. So we are done with the changes in assets and liabilities. Thus, each of the 4 static elements of financial statements, money, assets, equity, and liabilities, corresponds to 4 related dynamic elements. Changes in money are operating, investing, and financing cash flows and structural changes. Changes in assets are recognition, derecognition, amortization, revaluation, and reclassification. Changes in equity are profit loss, unrealized revaluation, transactions with shareholders, and structural changes. Changes in liabilities are recognition, derecognition, amortization, revaluation, and reclassification. This is the whole list of elements of financial statements. We have 4 static elements and 16 dynamic elements. This list is perfect. Why do I speak so confidently of its perfection? Because it's not just a list, it is the system. Each element has its proper place. Each element relates to other elements, and we see exactly how it relates to them. We cannot remove anything from this system, and we can't add anything to it from the outside. The only way we can change the picture is to differentiate the elements at a more detailed level. For example, we can divide dynamic elements into inflows and outflows. Then instead of 16 dynamic elements, we get 32. In addition, we can highlight some more detailed specific elements. For example, we can separate changes in money due to exchange rate effects from cash flows. IAS 7 states that those changes are not cash flows, but the standard requires them to be reported in the statement of cash flows in order to reconcile the amount of entities' cash and cash equivalents at the beginning and the end of the period already reported with the amount of cash flows for the period. It's paragraph 28. Such changes have some degree of convention since they depend on the presentation currency. In this context, I didn't want to isolate the exchange rate effects in a separate class of money movement, thinking that they could be considered part of operating cash flows in order to simplify the classification, as well as for purely aesthetic reasons to get a more elegant picture. But for the sake of accuracy, I have to admit that this is a separate kind of change in money. The situation is similar with assets and liabilities. Changes in their value due to exchange rate differences or inflationary effects under IAS 21 or IAS 29 does not appear to be a normal revelation. In this regard, we can consider these types of changes as a separate class of dynamic elements of financial statements. But all such clarifications do not change the whole picture. Money, assets, equity, and liabilities constitute the complete list of static elements of financial statements. These elements characterize entities' financial position at a certain date. They are internally balanced. Changes in these four static elements constitute the complete list of dynamic elements of financial statements, which characterize changes in the entity's financial position over a certain period. Dynamic elements are internally balanced too, if we take them all together. There is another video where the construction of this dynamic balance is analyzed in detail. I will not go into that here. All these static and dynamic elements are presented in financial statements. IFRS prescribes requirements for their presentation. But unfortunately, these requirements are not systematized. Because of this, the image presented in the financial statements looks like a motley creation of a surrealist artist. Users of the financial statements, seeing each element separately, do not see how they are interrelated. If the conceptual framework would formalize the described system of reporting elements and the standards requirements would be based on this system, IFRS would be much closer to achieving the goals set by the ISB to develop a single set of high-quality global accounting standards that bring transparency, accountability, and efficiency to financial markets around the world.